Welcome to Quick Invest Brief. In today's Quick Invest Brief, we're tackling one of the most ingrained financial beliefs. Is your main home truly an investment? For generations, buying a house was the ultimate financial goal, a symbol of security and wealth. But in today's rapidly changing world, with new generations valuing flexibility and alternative investments, this question is more complex than ever. We're diving into both sides of this powerful debate to give you the powerful insights. Briefly told, you need to make the right choice for your financial future. Let's get started. For decades, the mantra was clear: buying a home is the best investment you'll ever make. This belief is deeply rooted, especially for older generations. Your house was more than just shelter, it was your castle, a tangible asset that seemed to always go up in value. This perspective made a lot of sense in a different era. Property values generally saw consistent growth, and interest rates were often higher, making renting feel like throwing money away. It provided a sense of stability, permanence, and community. Psychologically, it offered a feeling of security and accomplishment. For many, paying down a mortgage felt like a forced savings plan, building equity slowly but surely. You were using the bank's money to acquire an appreciating asset. This belief system was powerful, and for many, it delivered on its promise, providing a significant chunk of their retirement wealth through home equity. Now, let's challenge this traditional view. While your house is an asset, calling it a pure investment, especially if you live in it, has some significant caveats. First, it doesn't generate income. Unlike a rental property or a stock that pays dividends, your main residence isn't putting money into your pocket. Instead, it's a constant drain. Consider the ongoing costs. Property taxes. These are a perpetual expense that often increase over time. Insurance, essential for protection, but another recurring bill. Maintenance and repairs, leaky roofs, broken appliances, painting, landscaping. Houses are money pits in terms of upkeep. Experts often suggest budgeting 1% of your home's value annually for maintenance. Interest payments. Especially in the early years of a mortgage, a significant portion of your payment goes to interest, not equity. Transaction costs. Buying and selling a home involves substantial fees, real estate agent commissions, legal fees, stamp duty, surveys, moving costs. These can easily eat up a significant chunk of any appreciation, sometimes 5 to 10% of the property's value. If you only live somewhere for a few years, these costs can wipe out any gains. Second, it's illiquid. You can't quickly sell off a portion of your house like you can with stocks. Accessing your equity often means taking on more debt or selling the entire property, a lengthy and costly process. Third, diversification. Putting a huge percentage of your net worth into a single asset, your house, in a single geographic location, is poor diversification. What happens if that local market stagnates or declines? Your entire investment is at risk. This perspective resonates strongly with younger generations who often prioritize flexibility, freedom, and lower responsibility. Many prefer renting to avoid the burdens of home ownership, freeing up capital to invest in the stock market, crypto, or even their own businesses, which can offer potentially higher returns and greater liquidity. Despite the drawbacks, there are compelling reasons why owning your main residence can still be a very smart financial decision, even if it's not a pure investment in the traditional sense. First, forced savings. For many, a mortgage payment acts as a disciplined, automatic savings mechanism. Unlike having extra cash in a bank account that might get spent, mortgage payments feel non-negotiable. This consistent principal repayment builds equity, effectively a savings account you can't easily raid. For those who struggle with discretionary investing, this forced savings aspect is invaluable. Second, leverage and appreciation. When you buy a house with a mortgage, you're using the bank's money, leverage, to control a much larger asset. If the property appreciates, you gain on the entire value of the home, not just on your down payment. Over the long term, property values have historically tended to rise, meaning your equity can grow significantly, often outpacing inflation. Third, inflation hedge. Real estate can act as a strong hedge against inflation. As the cost of living rises, so too often does the value of property, and critically, your fixed mortgage payment, if you have a fixed-rate mortgage, becomes a smaller real burden over time. Fourth, stability and predictability. Unlike rent, which can increase annually, a fixed-rate mortgage provides predictable housing costs for decades. This stability can be a huge financial and psychological advantage, especially in retirement when income streams are fixed. Finally, strategic wealth accumulation. For some, their main home becomes a critical part of a broader retirement strategy. They might live in a more expensive area during their working years, building significant equity. Then, in retirement, they can downsize to a smaller home or relocate to a cheaper area or country. The substantial equity released from their primary residence can then be used to fund their retirement, without needing to save as much in traditional investment vehicles. This strategy provides both a place to live and a substantial nest egg for the future. So, is your main residence an investment? The answer is, it's complicated and it's deeply personal. It's not a pure income-generating investment like a stock portfolio or a rental property. It comes with significant ongoing costs and liquidity challenges. However, it can be a powerful wealth-building tool through forced savings, leverage-driven appreciation, inflation hedging, and as a strategic component of a retirement plan. It also provides the intangible benefits of stability, roots, and customizing your living space. The right choice depends entirely on your financial goals, lifestyle priorities, risk tolerance, and individual circumstances. For some, the freedom and liquidity of renting and investing aggressively elsewhere will be the optimal path. For others, the stability, forced savings, and potential for significant equity growth through homeownership will be the better choice. The key is to understand both sides of the coin and make an informed decision that aligns with your vision of financial freedom and a well-lived life. Whether you choose to rent or buy, the most powerful insights are in understanding the true costs, the hidden benefits, and how your housing choice impacts your broader financial strategy. Make your decision consciously, not just based on societal expectations. Don't miss our next brief. Subscribe now to get more powerful insights, briefly told, delivered straight to your feed. Have questions or want to share your view? Leave a comment below.